Good afternoon, everybody, and welcome to today's webinar. Today we're going to discuss the stock market myths versus reality. So what I want to talk about right now is what we've had over the last 18 months. We've seen really spectacular price moves in assets, both the upside and downside. So remember, we did have some downside back in March 2020, and then subsequent rip higher pretty much over the last 18 months since then. What's interesting is when asset prices move like this, there's always a narrative that explains why they moved and why it will continue in reverse. And so today we wanted to spend some time and talk about some of these popular narratives and what it means for the prices, and also how sometimes it can be a little bit misleading. So the first narrative we want to talk about is TINA, or there is no alternative. And basically the narrative is that interest rates are at historic lows. Everybody knows that. You're going to try to put money in a savings account and CDs, you're not really getting any. And because there's no alternative, people want to find some type of return. What we have here is basically two charts. This is really as of yesterday. You're looking at, here's CD rates, which you go out to 5 years, you're only getting 1%, which is actually slightly better than on a 5-year than what you can get on a 5-year. These are the Treasury bond rates. Going out to 30 years, you're only getting 1.8% to go out 30 years on your money. It's always interesting because before 2008, you're getting about 4% on just money market funds, which is pretty incredible because if you were getting 4% today, people would be pretty thrilled. So the idea behind TINA is that because interest rates are very, very, very low, people need a place to put their money. So I want to take a step back and look at it and say, okay, why do people invest in CDs or treasuries or investment grade bonds? They're doing it really for safety, one, and to generate income. So, if you're a retiree and you need income, you want to generate that income in a relatively safe way. So when interest rates are low and you're looking for an alternative to those low interest rates, then investors should be looking to switch to other assets that provide also some relative safety and income. So what we're going to do here is we're actually going to look at some other assets and how that makes sense. So let's first talk about the bond market. So if you're not in treasuries or CDs or savings accounts or money market funds, then what are you invested in? So this chart on the left here is actually the high yield bond spread. So these are C-rated bonds. These are companies that have the worst credit ratings. And what this looks at is going back to really 1989. What that spread is relative to treasuries. So what's the extra return you're getting as an investor relative to risk? So when it goes up, as you can see, into this recession, you're getting basically 13% more return on a high yield bond than you are in a treasury. When things go better, they come down. This blue line here is really around 2.6, 2.7%, and that, for the last 30-some years, has been really the lowest level that it gets. It's dipped below there in the mid-1990s, in 2000, in 2014, and again we're sitting there at those levels again right now, at near historic lows. Now, what's interesting is if you look at the bond market as well, this on the right here is AAA corporate bonds. So these are the highest rated investment grade bonds and what the spread is. And so as you can see, going back to the 1980s, this line has actually trended higher, meaning, even though the spread goes up and down, it has been moving higher. So we're nowhere near all-time low spreads, which means that people are actually they're forced into, or are not forced into, but they're putting more money into high yield bonds, the riskier credit, than they are in the safe credit. So it's just one place. Again, if you're looking for an alternative, you would expect that investment grade bonds would probably be doing much better on a spread basis relative to high yield bonds. So next we'll talk about the stock market. So if you think about an alternative to bonds, then the bond-like stocks should be doing very, very good and be very expensive and doing well, because again, a lot of these dividend payers are in stable businesses, so they're not going to be as affected as much by the economic cycle. You know basically what you're going to get, and that is why those particular stocks should do well. So here we've got 4 charts, and if you just look at it very, very quickly, they look almost exactly the same. There's virtually no difference between all 4 of these charts. And what it is basically the S&P relative to different sectors. So top left is staples. This top right is telecom. Bottom left is utilities. Bottom right is pharmaceuticals. These are 4 areas of the stock market that have the least amount of volatility in their earnings. They pay the highest relative dividends and would be most likely the biggest beneficiaries of a TINA type market where there is no alternative. And so when you look at it, when this line is going up to the right, that means the S&P is performing. When it's going down, that means that particular sector is doing better. And as you can see right here, the only time that these defensive sectors really outperformed in any meaningful way was during the crash of March of 2020. The reason why I took this from December of 2018 was that was the peak in bond yields. 10-year bond yield was yielding like 3.3% at that point in time, and then precipitously declined. And so what you've seen is, even though that's precipitously declined from December, basically over 3 years, the defensive sectors, which should be beneficiaries of lower interest rates and should be beneficiaries of the switching effect, meaning people that instead of buying bonds, they're buying another asset to make up for the low interest, they've actually underperformed dramatically. So one of the things, and this is just another, again, this chart is a little bit more blown up, it looks very similar to the other 4 we looked at, is it's not just these stable sectors that we're talking about. So one can make the argument, oh, well, pharmaceuticals, that's people don't want to buy those anymore because there's so much government risk that they're going to change the pricing on drugs. Or telecoms, they have to spend so much money and take on so much debt in order to go from LTE to 5G and 6G. They got to spend so much money and they're not growing. There's a narrative for reasons why stocks aren't moving. But again, if you go back to the actual part of it, which is if interest rates are low and investors are looking for an alternative, they should be going towards areas that provide a like-to-like alternative. So let's throw all those other defensive sectors out and just say, let's look at all companies that are providing income. And it's the same thing. This is the S&P versus the Dividend Aristocrat ETF. So these are the best dividend payers across all industry sectors, and you get the same picture. So this idea that because interest rates are low means that there is no alternative and it's driving stock prices and valuations higher, it doesn't hold water, because the places that should be getting the most benefit are simply not. And the reason more so is because they're probably boring and we're in a speculative frenzy. So the next narrative is about central banks. And they're basically, the Federal Reserve is pumping the market with liquidity through low interest rates and quantitative easing. And this drives up GDP growth, asset prices, and inflation. So while this is new or relatively new to the United States in doing this much intervention, it's not as if this hasn't happened before. So what we're looking at here is a chart of the Bank of Japan. And this is their balance sheet. So what it means is basically quantitative easing is basically when the central bank goes in and buys, and in the case of Japan, they actually buy stocks, but you're buying stocks or bonds and you're making more money available for the markets. And so what you're seeing here, and this just goes back to 1996, but as you can see, from 1996 to basically 2006, for 10 years, the balance sheet slowly rose pretty much every single year. There's a couple dips here, but it basically went up. Then from 2006 to 2008, it started to drop. It leveled out, increased slowly, and then it's been an exponential increase from really 2013 on. Huge increase. So slow increase, stable, huge increase. And this huge increase is much more than what we're seeing here in the United States, but similar type thing because all the central banks are doing it all at the same time. So let's compare that. The Japanese, so they've been increasing their balance sheet much more than we have here in the United States. So let's see what it's done to Japanese GDP growth. Here again, same time period. Here's the GDP growth. 0 is this level here, and it has basically been, for most cases, other than a brief period of time out of the great financial crisis and a brief period of time coming out of the COVID crisis, it's been about 2.5%, give or take, drops down to 0%. Very, very little GDP growth. You can't see any correlation between GDP growth and the balance sheet. And what's also interesting is here, this yellow line shows this is when they went exponential in their balance sheet. And you saw a tiny uptick in GDP growth, but it looks no different than any of the other time periods. And it was slowly dropping and dropping. You have the crash, the spike back up, and we'll probably end up someplace as we go into next year, someplace in this area. No effect from the balance sheet and GDP growth. So again, narrative doesn't meet reality. But, well, all this money, all this liquidity going into the system, that's going to drive inflation. In fact, we were talking about that. That's been a narrative here in the United States basically since 2008. We've had virtually no inflation up until the last year, and that inflation has been more a problem with supply chains and workers than it is with monetary policy. So let's take a look again at Japan CPI. So let's leave the US aside and let's look at history and what does that mean because we've seen it in Japan. So balance sheet was increasing this entire time from 1996 to 2006. CPI, nowhere. Basically, you were more worried about deflation. CPI went nowhere. Then you had a spike right before the recession in 2008. It dropped. Now let's go and look at when it went exponential. Same yellow arrow over here for GDP growth and same yellow arrow over here for inflation. You have once they started it, you had an initial spike higher, which didn't last very long, and then it's been deflationary, even to the point where today you're at a negative CPI when everybody else in the world is doing great. So this idea that quantitative easing and Federal Reserve liquidity equates to better GDP growth and inflation, it just does not, it doesn't make sense. So, okay, fine, great, but it doesn't matter because maybe it doesn't help GDP growth or inflation, but it does help stock prices, right? So here's a look at the Japan index. So in 1989 and 1980s, they were in the midst of a bubble. If you look at this here, I mean, you can pretty much compare this chart to the NASDAQ of today. You have a drop down and then a super spike higher, of which we're sitting 30 some years later and it still has not recovered to this peak. Now, what's interesting is, again, going back to the balance sheet from 1996 to 2006, it was moving up on a pretty consistent basis. And stock prices, other than one move higher, moved down on a pretty consistent basis. And then you can see here, back actually, when they went exponential in their balance sheet, you do see that, yeah, prices move up, but there's no real correlation between what stock prices are doing in the balance sheet because it really doesn't make too much of a difference. Now, what it does do is when you're in a financial crisis, it does free up the markets and so that transactions can be made. Outside of that, once that emergency is done, doing this quantitative easing does nothing other than exacerbate potential bubbles because it causes people to take on a lot of risk. And risk and leverage, and we're going to talk about this a lot, that is what leads to the eventual crash because those excesses need to go away. So next, we're going to talk about the retail trading boom and how it's changing trading. Wall Street Bets has gotten a lot of notoriety. Robinhood with the big IPO this year, they've changed the game. And retail traders can now move markets. You hear about it almost every single day on CNBC about the retail traders. And I just want to take a look at this magazine cover from Forbes. A bunch of kids are tormenting Wall Street. High-tech renegades score big bucks making their own NASDAQ markets. I mean, it sounds like it sounds exactly like what's been happening and what people have been talking about in the financial media this year. What's interesting is that this cover is actually from 1998, which is the dot-com bubble. So all this talk about the retail trader and how they're changing things, and it's no different. It is no different than what we saw back in the dot-com bubble. So things are not necessarily changing. So what's the narrative around this? Wall Street Bets, no commission trading. This is creating a revolution where meme stocks can make a fortune for people, and they can take out the big hedge funds. I'm going to talk about this in a minute. A big hedge fund did go under, but here's the two stocks to look at. These are the big ones that get the most notoriety. AMC Entertainment, which was up 1,300%. Now this is just over the last year, so it shot up 1,300% in a very short period of time. And GameStop, which went up 2,400% in an even shorter amount of time. Those are the things that, it jumps off the paper. It's exciting. It makes news. And you can see both of them, they had spikes. And while they haven't come all the way back down, they're lower than where they were. And the argument is that, oh, well, this is getting a lot of attention on Wall Street Bets, and these retail traders are taking it to the hedge funds. Well, in reality, when you actually dig in and look at it, it's really the hedge funds and other big guys that are manipulating this market. And maybe, and I'm not saying that they're on Wall Street Bets and they're doing some things that are illegal. Maybe they are, maybe they're not. But I'm telling you, you can't have this type of moves and this type of volume without the big guys participating. So I'm going to give you an example. This is, again, AMC chart. Similar chart from before, but we're going to focus on one particular day. So that's circled here in yellow. On this particular day, the stock was up 33-something%. Now over here, this is the options volume for the September 17th contract at $45 a share. So this was trading around 36, and they were buying for 1 month out at $45 a share. Here's all the top trades of the day. So you can see there's small ones, 5 shares, 5 options, all these. But look at the biggest one here. This happened at 12:19 in the afternoon. A 10,000 block trade of call options came through for 45 to pay $2.36. No retail trader in the world is placing that trade. And what happened was, after that trade happened, there was a lot more options that came through. So I'm going to put this, let's look at this bullet point here. 10,000 contracts equals $2.3 million of premium, meaning somebody paid $2.3 million for the right to buy AMC at 45 1 month later. And that actually equates to, so if they're going to buy 10,000 contracts, that's 1 million shares at $45. That's $45 million of value if they decide to execute it. The average Robinhood account size is $3,500. The average E-Trade account size is $100,000, and Schwab is $240,000. This right here is an example that it is not the retail traders. That's the exciting story, but they're not the ones that are manipulating these stocks. And we're going to get into options a little bit later. But the idea that the retail trader is pushing these is a complete fallacy. Yes, they may be involved. Yes, it may be exciting, but they're not the ones that are driving. Someone else with big, deep pockets is manipulating this because they can, and they're making a killing doing it. The next one is that while the market has gone up so much over the last 18 months, it's going to continue to go up because there's still a lot of cash on the sideline that needs to get put to work. So again, go back to the first narrative, which is Tina, there's no alternative. And now there's still so much cash on the sideline that needs to get put to work. Just think about them right next to each other. You can't have both of those narratives even in the same place. Because if stocks are going up because there is no alternative, that means there's no money in cash. But if there's still cash on the sideline that still needs to get put to work, it doesn't add up. So let's take a look at what it looks like in reality. So here, this chart looks at the Bank of America private client equity holdings as a percent of their total holdings. So you can see in April of 2007, it was 56%. In March 2016, it was 62.5%. Right now, it's 65% of all their holdings. So all-time record allocation to stocks for Bank of America clients. That doesn't mean there's not cash, but again, where's that cash going to go if this is an all-time record high amount of money in stocks? So now let's look at margin. So what margin is basically when people go out and borrow money against their stock holdings or against their brokerage account in order to buy more shares. So the idea being is if you run out of cash, so if I have a $100,000 portfolio and I'm very, very confident that this market's going to go up and I can borrow another $100,000, I can actually put $200,000 into the market. 100,000 of my own money, 100,000 borrowed. If my stock doubles, then I borrow 100,000. 200,000 goes to 400,000 because I double it, and I pay the $100,000 back. I have $300,000. If I just invested all that cash, then my 100,000 goes to 200,000. So you can see why margin works to the upside. You make $100,000 more, you basically double what you would have made for the same amount of money. And so why is that important? Because, if it goes against you and goes the other way and you have to pay that money back, then you can really magnify your losses. So let's take a look at this chart. So up here, this top part, the gray line is the S&P 500 and the red line is margin debt. So here's going into 2000, margin debt and the S&P 500 go up together, they drop together. They go up together into the 2000 top, they drop together. They go up together in going into the 2020 crash, and they drop. We actually margin debt dropped before this crash, but we also had, this is 2018 where we dropped 20%. And it really coincided with that, never quite came back, dropped again. Since the March 2020 crash, it's been an explosion, an absolute explosion of margin debt. And so not only is this, a huge nominal level, but if you look at the percent of change, that's this down here. The only other two times in the last 20 years that we've had that much expansion of margin was basically right at the end of the dot-com bubble, right at the end of the 2007 top, and we've seen the same thing coming out of the COVID crash. And so, again, it goes to the point that there is a huge, so margin, debt, that works great as things move higher. But if it goes against you, then it causes forced selling and things can go against you to the downside very, very quickly. You don't use margin if you have cash. If you have cash on the sidelines, you spend the cash. Why would you pay interest and not spend your cash? So the idea that there's so much cash on the sideline with record amounts of margin being used, it doesn't add up. So we're going to talk a little bit about the problem with narratives. And this one I want to go back to because it looks back at something from a couple of years ago. The narratives don't usually tell the whole story. Again, the narratives come from the financial media and people that are, they have a business. Their business is to get eyes on what they're reporting. They want more readers, they want more viewers, and they're going to tell you something that's exciting, right? And doesn't necessarily tell the whole story. So we're going to go back to the 2019 rally. Very, very similar to 2021, very, very similar to 2017. And 2019, for 6 to 8 months, all we ever heard was discussions about the trade deal, the big trade deal with China. And every once in a while, we get a 1%, 2%, 3% down for a couple of days because, there was issues with the trade deal that was going on with China. Maybe it wasn't going to happen. And then, oh, okay, well, they fixed some things and it is going to happen. Now, the idea behind that was that once this trade deal came into place, it was going to cause an excellent economy for both the U.S. and China, and that was why stocks were moving higher, because they were predicting. What's interesting is, again, narrative. When you take a look at it now, this is 2021. The dotted line is what this phase one trade deal was outlining, and the blue one is what actually happened. So a huge, huge disappointment. So if you're rallying based on a trade deal happening, and you're pricing things in based on what's projected, and it disappoints to the downside, then those prices would have to recalibrate back to the downside. Never happened. Nor do we ever hear about this trade deal ever again. We haven't heard about it for 2 years. Yet it's in place, and this is what reality is. And that is what happens with narratives. We move on to something else. The trade deal's over. It doesn't really matter. And it was not necessarily the reason for why things were going up. Because if it was because of the trade deal, when the trade deal falls short, then those prices that went up should be reversed. So let's talk a little bit about what is really happening. First off, we are in the midst of the biggest bubble of all time. There is no doubt about this. It is rotating between assets. So stocks, bonds, housing, NFTs, crypto, commodities. You're seeing one asset and another just going absolutely parabolic to the upside in their moves. And then in some cases coming down the same type of way. Additionally, leverage, options, and money flows are more important than narratives and fundamentals. Now, what do we mean by leverage? I brought this up a couple times, leverage. So think about it this way. If you were to go outside and in your yard, there was a huge boulder, right? And you needed to move it. You needed to pick it up. If you went over there just by yourself and put your hands around it and tried to lift it, you wouldn't be able to move that boulder or lift it whatsoever. Now, if you got yourself a 2x4 and you put it underneath that rock right on the bottom, and you stood on the other side and you pulled down on that 2x4, you would be able to lift that rock up because you have leverage, right? You have leverage. You're able to use something else, physics, to lift that rock up. The same type of thing happens in finance. You're putting less effort in to lift something up. Same thing happens both to the upside and downside. So you're using, options or debt to magnify your returns. Same type of scenario. So where do we think that is ground zero for this? And it's the options market. And options are a leveraged way to play stocks. So options are a derivative of stocks. I'll use the word derivative because that is part of the reason that the 2008 financial crisis happened. Was derivatives, which were fine, then were overused, abused, and collateralized and put into many different packages. So there was risk that nobody even knew that they had. Very, very complex instruments. Options, maybe not quite as complex, are much more complex in their pricing than stocks. So without getting into too much detail on the pricing of options, I just wanted to give you an example. So a small move in a stock can provide enormous gains or losses in the option. So here's just an example. Here's a stock from today. This is a uranium company called Cameco. CCJ is the ticker symbol. This is from today. Here's the stock on the left. As of 11:30 this morning, the stock was up 2.87%. Nice gain, but not too much. Here's the same option, or one of the options that expires this week. That same option, while the stock was up 2.87%, the option was up 47%. Again, look at the graph. Same shape, and both of these, huge difference in returns. So that is why it's a leveraged way to play the stocks. Because when you look at it, the option, so again, this one here is September 24th, 2021, and it's $21. So you're basically buying the option to, by September 24th, which is only 2 days away, to buy the stock at $21. And you're paying $1 for that. And that's what an option is. If it goes up, it's great. Now let's just say in the next 2 days, Cameco drops to $20.98 a share. Well, why would you buy the stock at 21 when you can buy it at 21.98? So you not only, if you paid $1, you would lose 100% of your money in 2 days by buying that option. So you could make 47% in a couple of hours, and in a couple of days you could lose 100% of your money. That's what I mean by leverage. It is a huge, huge gamble for even just a couple of days. So let's look at the options market. Currently, the options market, the volume is 1.4 times the actual stock volume. So what does that mean? So if you have a stock like CCJ, you're getting, and you trade one share of CCJ, or let's just say, 10 shares of CCJ, you're trading 14 options contracts. So you're trading more options contracts than stock volume. So here's, if you look at this chart, you go back to 2017. From 2017, it's basically 40% of the volume. You have some spikes here, which is actually in 2018, it spiked briefly before we had our 20% correction into the end of the year. And then in 2019, it spiked briefly before we had our 30% correction in early 2020. But realistically, it stays around 40% options volume to stocks. So again, it happens, nobody even really notices. As you come out of the COVID crash, there is a gigantic spike in options volume. Huge spike in options volume. To the point where we're sitting now, and at one point we were 120%, 140, 140% of stock options. So, okay, that's great. What does that necessarily mean? What's interesting, we'll take a look here. The gray line is single stock volume. The blue line is stock options volume, just for the last 2 years. Single stock options have been increasing, and you've got single stock volume, which peaked in March, April of this year, and is actually about the same level as it was 2 years ago. So pretty consistent, even though stock option volume has gone crazy. Now, what's even more fascinating by this is the options volume is happening in shorter and shorter periods. So what do I mean by that? Options they expire 1 week, 2 weeks, 1 month, 2 months, 6 months, 12 months, 2 years. There's a lot of different expirations. And the further out you go, the more chance you have to be right. So let's just give an example. If you buy a stock at $10 a share, you can hold that stock forever if you wanted to, assuming that they don't go bankrupt. So let's say in 3 months, stock drops to $5, and then in 6 months, it goes back up to 15. You can hold it for that entire period of time. With an option, if you're wrong for any period, so if it drops from 10 to 5 and then goes to 15, if you're in an option that expires in 2 weeks, you would have lost 100% of your money. And so the shorter the time period, the more speculative and gambling it is. So why is this chart important? again, let's go back to, so this shows the percent of stock options that expire within 2 weeks. So 2 weeks or less. Very, very short time period. From 2013 basically to 2019, it's about 50% of all the volume. That makes sense. You know, half of it is short term, and that's for many different reasons. The other half is long term. But since that time period, it's gotten shorter and shorter to the point where over the last year, and again, this is right here, this little blip was the COVID crash, and then this spike right out of it, and it stayed at these elevated levels between 70 and 75%. All the options volume is expiring within 2 weeks. That's speculation and gambling and leverage. It is not investing, and it is just a pure gambling casino. So why is this all important? So I've explained it's very, very obvious the amount of use of options that are going on. But how can that influence the price of the stock? So we're talking a little bit about the mechanics of the stock market. So in the stock market, when you're just buying an individual stock, there's a market maker that matches a buyer and a seller. It says, okay, this person wants to buy, this person wants to sell, their price is $5 a share. Okay, we're going to match them and clear. They don't take a position, they take a little bit of a spread, and then they clear the transaction. Now, what's different in the options market is they actually, because of the way it happens, they actually will take a position in the options. So if you want to buy, go back to AMC, if you want to buy 10,000 contracts, the market maker most likely can't find somebody that's willing to sell 10,000 contracts. So what they'll do is they will take the 10,000 contracts on, and then we'll make a spread on it. Now, a market maker, so the second thing is a market maker does not make a directional bet. They're not saying, oh, well, if you want to buy it, I'm betting that AMC is not going to get to $45 a share. And so I'm going to go against you. And if I'm right, I make a lot of money. If I'm wrong, then I lose. No, they're not making a directional bet. They profit off the spreads and the volume. So if you do 10,000 contracts, they can't find somebody to take on the 10,000 contracts. They say, okay, I want to hold those 10,000 contracts because the spread is big enough, I can make a lot of money. What they'll immediately do is hedge themselves. They'll hedge their position so they're not making a bet on the stock. And so what happens is when there's call options like this, if you buy 10,000 contracts and the stock price continues to go up, the market maker could lose a lot of money. So instead, what they'll do is they'll sell you the contract, and then they have to go in and cover those shares by buying AMC. So they make the spread, they hold it. If AMC continues to go up, they don't lose, they're hedged. So they just make the money on the spread. So what happens is if you inundate the market with options, then you're forcing market makers to buy more shares. That's how you get a squeeze. That's how AMC goes up 40% in a day, 100% in a day. That's how GameStop goes up 100, 200% in a day. It's because of these options plays that are causing forced buying in the market. And the more calls that happen, the more buying that happens. The more it goes up, the more people think they're making money. It's this loop. Now, it sounds great. Okay, well, why doesn't everybody do this? Why, how come this hasn't been done before? And this is, again, why I pointed out, this isn't the retail investor that's figuring this out and doing it. That's why you saw 10,000 contracts of AMC. These are big players that are manipulating this market and taking advantage of it. So here's an example of options and what it can do to a price and how it can go bad. So earlier in this year, we had a hedge fund called Archegos that actually blew up. Now, what they were doing was buying options on buying stock and then buying options on these certain positions to benefit when the prices go up. And at the same time, they were shorting other stocks as well to try to benefit on both sides. What happened with this company was when GameStop started going up, they were short GameStop. They had to continue to cover, and because they used a lot of margin, once it went against them, they didn't have enough money. The fund got liquidated, and they were forced to sell. So when you're forced to sell, it doesn't really matter what you hold. You're selling, you're not selling it based on fundamentals. You're selling it because you're forced. That's what's called deleveraging. Okay? So the forced liquidation is deleveraging. So here's a look at Viacom. Viacom has nothing to do with GameStop, has nothing to do with anything else. The stock went in 2.5 months up 188%. And then when this fund got caught, it dropped 60% in a matter of 3 or 4 days. Now, was the run up and the run down, was anything have to do with fundamentals? No, it had to do with the fact that Archegos was piling into this stock, had stock and was piling in more with options. And those flows were inundating it and causing the price higher. When they were forced to liquidate it, it caused the price to come back to some type of equilibrium. So we've been around $40 a share. It's probably more like an equilibrium at this point in time. But this here was completely artificial. So what's interesting is, and this is going to tie this all back together, here was the actual narrative around the move in Viacom when it had its 188% gain. So actually in January, here's an article from February 6th. Why did shares of Viacom rise 30.2% in January? First 2 paragraphs. Well, it was a legacy TV provider that was under pressure from cord cutting over several years, and it fell to a bargain basement level. Then a big announcement regarding Viacom's streaming ambitions, along with some short squeezes, helped rocket it higher. Now, this is just a snippet, but the rest of the article goes around to tout all the streaming and how it's going to compete with Netflix and how things are changing, the narrative's changing around this particular company. That's why it went up. Now, what's fascinating about this, again, is if you look here, the second article, when they announced streaming, was in June of 2020. 6 months before the stock price moved, they announced streaming. The stock went nowhere after this announcement, and then skyrocketed, not because of fundamentals, but because of the options and the leverage that was in it. This is happening. This is just one example, but this is what's happening over and over and over again because there is a lot of leverage in the system. So now we're going to talk about looking forward. There are going to be a lot of narratives, and those narratives are going to change, and they're going to change quickly, and it's going to be based off of price. There is a ton of leverage in the system, tons of debt. People have taken on risk. Companies have taken on risk because interest rates are low and they're borrowing like crazy. These problems do not get solved quietly. Great example this week, all of a sudden in the news, even though it's been going on for months, is Evergrande in China. Way too much leverage. The company's basically going bankrupt. They're defaulting, and it's because they have too much debt and they can't service it, even with interest rates as low as they are. The deleveraging process is painful with lots of collateral damage. Just like leverage causes things to go up exponentially, it also causes them to go down exponentially because there's forced selling that's involved. And there's collateral damage. Using the Viacom example, GameStop was the problem for Archegos. Viacom was sold off because of the leverage that Archegos as a fund used to basically blow up the fund. It was collateral damage. At the end of the day, once the deleveraging process is over, it does create huge investment opportunities because there are certain businesses that are sold indiscriminately just because somebody was overexposed and it gets below fair value. Not even close to that level yet, but that's where the huge investment opportunities are come from. The Federal Reserve knows they have a leverage problem, which is why, and they have no solution to fix it because their low interest rates and their buying of bonds and freeing up of the credit is what caused this. So they can't take their foot off the gas without causing this deleveraging and this collateral damage. That's why they're dragging their feet, even in the face of inflation and other problems where there's no need for this type of emergency type quantitative easing, because there's no emergency. So we expect that the volatility is going to increase substantially as this deleveraging process kicks in, and it battles with people that are trying to buy the dip every time we see a little drop. So the course of action is know what you own, buy things that are cheap, take advantage of the elevated options volumes, and prices, not for speculation and buying things within 2 weeks, but using it to write covered calls, using it to collect that premium, enhance income, use it for risk mitigation. Look for investments that can hold up when the deleveraging process begins. It may or may not have started already, still don't know, but think about those first few slides, those TINA investments that should be benefiting from low interest rates that are trading at huge discounts and are being overlooked simply because their options, their leverage, they just don't have enough action, so people are not looking. And regardless of what happens, you know that their dividends are going to be safe and their earnings are going to be safe. And lastly, you got to reduce earnings expectations going forward, because earnings are and returns that are just with low interest rates, high inflation, high valuations, it's going to be very, very difficult for the average asset to do well. So that's all we have today. If you'd like to have a follow-up, there's a lot more going on. I tried to keep this somewhat short. You can book a calendar invite or email me, and we can have a longer discussion. Thanks again. I appreciate it, and have a great day.